Welcome to Empowering Plans, a show dedicated to identifying waste and undue expense in the health benefits industry, discovering ways to maximize benefits while minimizing costs, and empowering employers, administrators, and consultants to emphasize, once again, the benefit in benefit plan. Today's episode is brought to you by the FIA Group, empowering plans since 1999. Now here are your hosts, the FIA Group's own CEO, Adam Russo, and Senior Vice President and General Counsel, Ron Peck.
Good day, everyone. Welcome to another episode of Empowering Plans with the FIA Group. I'm your co-host, Adam Russo, CEO and co-founder of the FIA Group. With me, as always, one of my best friends, my Senior VP and General Counsel, Ron Peck. Say hello, Ron.
Hello, Ron.
Ron, once in a while, maybe we can say something different. Don't just say hello, Ron. Maybe mix it up a little bit.
You know what? I had to do it so many times in order to trademark it. Starting something new now, I'm getting too old for that.
It's like that show on the TV. What's it called? The Locker Wars, or when they open up Storage Wars.
Yeah.
And that guy has the saying. I don't know what it is, but it's on his hat, and he trademarked it, and he says it every time he bids on one of those.
That's it. I'm hoping to start selling some Hello Ron merchandise.
That's a good idea. So today, folks, it's renewal season. It's also hurricane season, and for those clients of ours and friends of ours who were affected by Hurricane Harvey and now Irma, and it looks like Jose, we apologize. I actually have one client who's a good friend of mine who luckily didn't lose his house in Harvey, but had a lot of friends and family that did, and now his office is in Florida. So his home was in Houston, his office is in Florida, and now they're preparing for evacuation. I'm like, man, this guy just got to move north where we are. I mean, the worst thing we get is, a foot of snow.
I've got to tell you, next year, this winter, when I am shoveling snow after the first nor'easter, I'll be smiling.
My favorite is when you watch CNN and they actually have live shots of people who say they're going to live in their sailboats during the storm. Live in their sailboats. Now, why don't they just take these people and literally put them in prison? Can't we get rid of those people from this country?
Well, you know what, Adam? While we're on the topic, it's actually interesting. I know a lot of people say, well, that's their choice, but it's amazing to see how those choices impact other people, because ultimately, if they end up in harm's way, they'll be sending out the Coast Guard, and it's actually not too different than the whole insurance industry.
They won't send out the Coast Guard. They won't. If
saying.
You're out there on your own, this is it's on you. So let's get back into our topic of the day, which is revisiting stop-loss trends, and the reality is that it's a renewal season. Most people don't think about stop-loss. They obviously focused on renewing their client. They're trying to get that business for 2018. They're looking at their plan docs, etc. But how employers and brokers choose stop-loss carriers is based pretty much on the price, which I try to tell people all the time. You need to look at more than just the underlying price. We're going to talk about some of the stop-loss trends because we have a webinar later on this month on Thursday, September 21st at 1 o'clock to 2 o'clock called It's Time to Renew, Revisiting Stop-Loss Trends. This will be a prequel as to what we're going to talk about during that 1 hour webinar. But I can tell you, folks, there has never been a time in our history, in the FIA Group's history, and that's a 17-year history, where we have seen so much pushback from the stop-loss world as it relates to claim reimbursement. I think a big part of it is many of our stop-loss clients, many of our friends in the stop-loss world are getting killed when it comes to claims. The amount of the claims, the number of claims, the size of the claims, it's getting bigger and bigger, just like hurricane season, Ron. And speaking of, and I know we're sidestepping here, and I apologize for that. It's the last time, Ron, I promise. So, folks, I like to share personal information, as you all know, when I speak on the road, etc. I had a vasectomy on Wednesday. Ron, do you know what that is?
Unfortunately, yes, Adam.
So, folks, I literally went into this experience. My wife asked me to do that. I can't believe I actually said yes. But about 5 minutes before walking into the doctor's office to have this, so-called surgery, this procedure, it is evasive. Okay, let's just put it that. Let's just cut to it.
This is an invasive procedure.
This is horrifying. 5 minutes before, I get a phone call from a buddy of mine who literally had this done. He goes, "Oh, what are you doing?" I'm like, "Oh, I'm going to have the vasectomy." "Dude, turn around. Go home." "What?" "Go home. Don't do it. It's not worth it." "What?" Ron, I'm happy I went into this thinking that it's not a big deal. Folks, I'm still in pain. Now, again, I am not comparing this to childbirth or anything else because I know women have it way harder than us. But this definitely was, to me, the most painful experience I've ever had. And I've had root canals.
Just imagine how much more painful it would be if we didn't have a quality health plan covering the cost.
By the way, so we go to the doctor. This talks about healthcare. I go there, and the woman goes, "You have $1,000 copay." I go, "Excuse me? $1,000 copay." I'm like, "Ma'am, that's not possible." She's like, "Oh, yeah, you're right. It's not covered under your plan." I'm like, "So now you're telling me it's not covered under my plan, and then you tell me it's $1,000 copay." I'm like, "Ma'am, you're wrong." She's like, "Sir, you're gonna have to talk to your administrator." I'm like, "Ma'am, I am the administrator. I wrote the plan." The woman looked at me in the billing department like I was crazy. Now this is before, like 2 minutes before I'm walking in to get sliced up. Okay, she's telling me 2 minutes before that it's not covered and it's $1,000 copay. I go, "Ma'am, I wrote the plan. I know it's covered, and guess what else I know? There is no copay." I'm like, "This is the FIA Group plan. It's the best plan ever written. There is no copay." The woman took 5 minutes, looked around. She says, "You're right, sir. I apologize." She's like, "Wow, can I come work for you?" That's the first thing I said. As I noticed is how often we hear that now. People need to realize what your employee benefit plan has in it can and should be used as a recruitment tool to bring in new employees. Because more and more employers, more and more insurance companies are trying to just shift the cost to the employees with these out-of-pocket maximums. The reality is changing your plan design to innovate, to incentivize your employees to care about lowering the overall cost of care. Let's be honest. The fact is me having a vasectomy is going to lower plan costs. There is no chance I will have a dependent on my plan, which is going to be cheaper for the plan overall. Right, Ron?
That is absolutely correct.
Well, they
Adam.
say you have to wait 3 months before literally you're shooting blanks. So we'll see what happens.
On
within the next
behalf
few
of the
months.
plan, we thank you for your restraint.
All right. So let's get into it. Folks, we appreciate your time, and I know there's a couple of things we want to bring up. First thing I want to bring up is what we actually see in the stop-loss policies. We have probably reviewed every stop-loss policy, analyzed them all, and what I can tell you is, and Ron, feel free to chime in on this as you want, not all stop-loss policies are the same. I could think of 2 stop-loss policies that we know there are no gaps, that we wouldn't even do a gap review because if the claim is payable under the plan, it's payable under the stop-loss policy. Now, that doesn't mean you're out of the woods for those 2 stop-loss policies because the plan still has to follow the terms of the plan, which in many situations they don't. But at least in those 2 situations, all you got to concern yourself with is following the terms of the plan doc, not what we're seeing when it comes to other stop-loss policies.
Absolutely, Adam. You're correct. There are 3 swings at the plate. The first swing, check the policy. What does it say? Swing number 2, what does your plan document say? And when you compare it to the stop-loss policy, how do they line up? And then swing number 3, how are you and the stop-loss carrier going to interpret those documents, both the plan and the stop-loss policy?
Now, I know you're thinking of swinging as a baseball analogy. I'm thinking of it in different terms right now just because of what I had to go through. I really appreciate if you wouldn't use that word.
Painful, Adam. I'm so sorry.
Thank you. So, a couple things. First off, folks, look at the definitions within your stop-loss policy. The first one, that if I'm you, run away, discretionary authority, where the stop-loss carrier has its own right to interpret the terms of your plan. So whatever you think the plan says, they can say, no. Even though you wrote it, we define it this way. Talk about a gap, Ron.
That is what I think almost counters or cancels all of the good that comes with mirroring. You could have a stop-loss policy that basically says, we don't have any exclusions, we don't have any definitions, we mirror the plan 100%, but we have discretion to interpret your plan. Now, all of a sudden, that single plan document, it's almost like 2 different documents. One interpreted by the plan, the other interpreted by stop-loss. You see it all the time with UNC pricing, where the plan, let's say they're paying claims to an out-of-network provider, they're pricing it based on their interpretation of their UNC language. Stop-loss goes, they get the claim, they reprice it completely different based on their interpretation of the same exact language.
Next one, experimental investigational. The reason I'm bringing this one up, it's typically high-dollar claims, right? Rare form of cancer, a mix of drugs, a mix of procedures in order to try to innovate and try to cure something that maybe isn't curable. We often see language in a stop-loss policy where the language is totally different. So what might be covered under the plan is not covered under the definition of experimental investigational. We call that E&I. under the stop loss policy. Thoughts, Ron?
I love it. That is an example of where there isn't mirroring. There's two different sets of language. The problem is you'll end up having a plan which has a plan document that says they're going to do one thing. Stop loss policy says they're going to cover something completely different. And the problem is that plan now can't serve two masters. Either you pay according to the plan and stop loss won't reimburse, or I've actually seen instances where the plan goes and pays what they think stop loss wants. They pay per the stop loss policy, but then it's the provider who's going to come after them for more money, and that provider is going to win because the provider wants to be paid per the plan document. They really don't care what your stop loss policy says.
Folks, really simple. Have the FIA group review your stop loss policies just to tell you what the gap might be. You're talking about a few $100s, and I'm going to keep going over more examples. The definition, Ron, of the word incurred. The plan document and the stop loss policy have two different definitions of what incurred means. Meaning, if a person is having ongoing courses of treatment, the date of something is incurred might differentiate between what the plan says and what the stop loss policy says. So you have a run-in or run-out claim issue. Ron?
You know, that's another example where you may, reading the two documents side by side, think they mean the same thing, but because of that ambiguity, if you don't discuss the meaning ahead of time, you're going to find out that it's being interpreted differently after the fact, and that scares me. So that's one of those examples where if you have someone review the plan, you have someone review the policy, point out the fact that there are subtle differences between the two definitions, that gives you the ability to go to the carrier and discuss it ahead of time and agree on what it means.
My favorite one, definition of usual, reasonable, and customary.
Oh, boy.
Folks, if your plan doc has one definition, and that definition is pretty loose, you're definitely not using FIA's definition, right? It's not tight. If you have a definition that's pretty loose, meaning you're going to reimburse the provider what charges that provider has in that particular area, and they're the only hospital in the area, meaning you're stuck paying at 100% of charges or 90% of charges, many stop-loss carriers limit UNC to what that typical provider might be paid, or they might limit it to a Medicare-type reimbursement. We see that more and more now. Look at that language as well to make sure there is no difference there. Best part, if you're using good language like ours, maximum allowable claim payment, even if there is a gap, what's allowed to be paid under the terms of the plan is typically less than what the stop-loss carrier would have to reimburse based on their language. So often, the stop-loss policy language, if you have FIA's plan doc, the stop-loss policy language is looser than the plan's language. Ron?
Ultimately, what providers are going to do if they're out of network is they're going to seek payment in accordance with the terms of the plan document. And like I said before, they couldn't care less about what the stop-loss policy says. However, if you can interpret the plan language as matching what the stop-loss policy requires, you can now tell that provider, we paid what the plan document requires, and you can turn around and tell the stop-loss carrier, our plan requires us to pay the same amount that your policy allows you to reimburse. That's called matching.
Next one, their own definition or exclusion for workers' compensation coverage. How workers' compensation is defined differs all over the place. I can tell you right now, we have seen a template where there was 28 different definitions and exclusions written for workers' comp. If you had a job where you were getting paid any amount of money and you were injured, there are policies, there are plan docs that say that claim, even if workers' compensation coverage isn't available, it's not eligible for payment under the terms of the plan. So when you have a difference, a gap between what the plan doc says is the definition of workers' comp and what's excluded under the definition for workers' comp under stop loss, you potentially have an issue there as well, Ron.
You know, that discussion, what level of exclusion do you want to apply to workers' compensation? Are you going to exclude all claims if someone's working for wage or profit regardless of workers' comp? Are you going to exclude only if workers' comp is available? Are you going to exclude if workers' compensation is present regardless of whether they cover the claim or not? That's a conversation you need to have when you're writing your plan document. That's true. But you also need to make sure that stop loss is then part of that conversation as well once you decide what you want to do and make sure that they agree to that definition.
The next one is a combo. COBRA coverage, eligibility. These are also areas where the plan might be stuck paying a claim, either based on the handbook or their plan doc, that the stop loss carrier doesn't have to pay. Folks, trust me, if I'm a carrier, it's a lot easier to deny a claim for some kid, right, with some rare form of cancer by stating that the claim isn't eligible for reimbursement versus stating the reimbursement amount is above the usual and customary and reasonable amount. If the person's not eligible, sorry, we'd love to pay it, but this kid's not covered under the plan. That's much easier to say, and we're seeing many, many more policies outlining that type of gap to help them in these large claim situations.
Yeah, the same way that the provider is not required to care at all about what the stop loss policy says, they're just enforcing the plan, and if there's a network, the network contract. Same thing here when you're looking at an employer's handbook. If the employer handbook says, hey, yeah, it doesn't matter how long you're away from work, you're eligible, you're covered. If your plan document doesn't say that, stop loss isn't bound by your handbook. They're bound by the plan document, and that's it.
It goes right into that whole leaves of absence, right? That's the soap opera show that we have at FIA Group.
Leaves of absence.
Right. The bottom line is you have to look at those provisions to make sure there's no gaps in your stop loss policy when it comes to that. The next one I know is Ron's favorite, and it's definition of word paid. When a claim is paid. Ron loves these, right? The mailbox rule. We learned all about that in law school. Ron, you want to share some insight on how that could be a potential issue?
Yeah, sure. So back in the day, when payment meant I'm going to cut a check, I'm going to put it in the mailbox, there's really only two definitions: when I put the check in the mailbox or when the mail is delivered. I suppose also when the money is withdrawn and deposited, you could use that too, so we'll say 3. But this day and age, you have clearinghouses, electronic payment, right? So if I'm a plan or I'm a plan administrator and I instruct my clearinghouse to make the payment, that date that I issue instruction, in my mind, that's when I told them to pay. That's when payment was made. But then there's when the instruction is received. Then there's when they actually cut the check, assuming there is even a check. What if they're transferring funds electronically? There are so many different stages in the payment process these days. If you don't confirm exactly at what point payment is made and then confirm with stop loss that they agree to that definition, there's going to be a gap.
The last but not least is this one. It's one of my favorites. It's the right for the carrier to audit. When I say audit, I mean all records, all procedures. Basically, folks, this allows a carrier to prolong the amount of time they have before they have to reimburse you. They basically can ask for anything. If there's audit language in that policy, luckily for us, we don't see that many of these, but when you do, be ready to share bank records, bank statements. They're basically looking for any reason they have whatsoever where you're not following everything to the perfect T, where they can identify a reason and not reimburse you, but also delaying the ability for them to have to reimburse you. Ron?
You know what's really scary when you have a self-funded plan and they're utilizing either a TPA or a carrier-owned ASO, and their administrative services agreement with that claims processor basically says, here's the information we're willing to give you, and here's information we're willing to protect. Particularly with the ASOs, they say that the claims data is proprietary. And then on the flip side, you have a stop-loss policy that says exactly what you're saying. We require all of this information in order to reimburse. Otherwise, we're not going to reimburse. If you have an ASA with your carrier, ASO, or TPA that says they're not going to give you that information, and the stop-loss carrier says that they require that information, you don't have to wait until there's a claim to know that there's a problem, and you better get it straightened out.
So here's the reality, folks. Most of the carriers in the stop-loss world are great people. Most of the companies are great companies. But what we're seeing is there are a few out there that because of their loss ratios, because of what's happening so far this year, they're trying to have a better year. In order to have a better year, they have to reimburse less claims in order for their year-end numbers to look better. So don't be surprised if you're with one of these carriers that has bad language in their policy that you won't be reimbursed as quickly or you might get that denial letter. To give you an example, right before I walked in here, I just wanted to look quickly in our FIA Group consulting department to see how many active cases we have that are pure stop-loss denials. And Ron, guess how many that we have? 283 of these cases right now.
Ouch.
And I'm looking at a letter that I received from a big-time law firm in Pennsylvania from last week. And this is a real letter. And in the letter, it specifically says that the insurance company determines what's reasonable. Number one, like we talked about. I'm reading from the letter. Number two, it says the stop-loss contract supersedes the SPD. It's right there in the letter. So don't take my word for it. Take this law firm's word for it. These are the kinds of things we're seeing. We've never had over 200 open cases at any one time. We have attorneys whose specific jobs is to do nothing but stop-loss claim exclusion issues. So if you have this issue, please feel free to reach out to Ron and myself and we'll help you out. Because as you know, we're here to empower your plans. That's all the time we have for you today. On behalf of Ron Peck and myself, we hope you have a great week. Good luck to all of you that are in the path of the hurricanes. We hope you guys make it out safe. God bless, and see you next time.